Good morning and welcome to my presentation. My name is James Wink. I'm the Head of Sales and Partnerships at Acumenor. Acumenor is a reg tech business. We specialize in financial crime threat intelligence here in Stockholm. Just a little bit of background to myself before going into the presentation. I've been working for nearly 20 years now in financial crime technology and financial crime data. So I moved to Stockholm in 2015, but I've been working for organizations like RELX Group, which has the brands LexisNexis Risk Solutions and Furcosoft, for example, focusing on customer screening and transaction screening. Prior to that, I worked at Fiserv, which is a large American software company where we had transaction monitoring and fraud monitoring tools. We helped a lot of institutions globally with those sorts of challenges. And then prior to that, I worked at Thomson Reuters through an acquisition of a company called Complinet, where I started out, which had brands like WorldCheck, you might be familiar with, again, around the financial crime data. So I have a fairly diverse background working within financial crime tech and financial crime data. So hopefully some of the experience I have today will be useful as we go through this presentation. So let's have a look at the topics that I'll talk about as we go through. We'll start with an introduction, the sort of landscape as I see it right now in terms of financial crime data and how that's used, how that's managed and used. I'm anticipating a fairly mixed audience here. Perhaps not everyone will be a expert in financial crime. Perhaps some of you are, but I've tried to sort of start with some of the basics, some of the 101 stuff. So we'll look at what do we mean by financial crime and why is it such a big problem. Then we'll move on to the data itself and what are the data that we use in financial crime prevention. The evolution of that data over time. We'll see that things have changed pretty dramatically with that data. And then we're looking more through the processing of that data and where it's used within an anti-financial crime framework. I'm going to talk a little bit about the importance of good threat intelligence and why that drives better outcomes in in preventing financial crime and good financial crime compliance. Before I take a peek through the looking glass and look at sort of what tech and data is emerging now, that we're going to start seeing firms use more and more to get, again, better outcomes in daily operations when it comes to financial crime data. So the landscape right now, I suppose the important thing here is to recognize that for a long time now, the levels and the volumes of data within financial services firms has been growing massively. We'll look a little bit about that in the history, but it's now at a point where there's massive amounts of data within a bank or other regulated entity when it comes to data. At the same time, there's a timeline of increased regulation. So the compliance requirements that organizations now have placed upon them by governments and regulators, that has increased significantly over time. So we're kind of at this sort of perfect storm, if you like, where the data's been increasing and becoming more complex. The regulations are now more complex. And that perfect storm it really results in much higher costs potentially of handling and using that data. So firms need to be smart about how they do things. They need to find ways to new and innovative ways to handle and manage data, because of course they can't just deal with increasing costs and increasing compliance without doing things in innovative and smart ways. So a little bit of sort of basic stuff now. Sort of what is financial crime? Apologies if this is something you know already, but I think it's useful just starting from the beginning. So financial crime is commonly considered as covering the following offences. So money laundering, so taking dirty money earned from illicit means, and then cleaning it in the financial system. That's what we call money laundering, and we include fraud and cybercrime in that nowadays. Terrorist financing, bribery and corruption, and market abuse and insider dealing. And the last one there, if you're not so familiar, is things like market manipulation, where you might use confidential information on a company that's about to be a public company that's about to be acquired, for example, and that information is then shared. And because the stock price goes up, you then make some money out of it. That's illegal. You can't do that. That's called insider dealing. So that's something that's covered in financial crime. And then we have something called predicate crimes or predicate offences. And what that really means is the offences that happen before the money laundering. So drug dealing, tax evasion, environmental crimes, all these different threat types, criminal threats that face the financial sector. They're the predicate offences that then lead to the money laundering. So you sell your drugs, you get your money in cash, for example, you then need to find a way to clean it. And that would be money laundering. So why is it such a big problem? We often hear about, economic crime, white collar crime, victimless crime. That's really not the case at all. I think the first point to mention here is it's a huge problem for the globe. If we look at the top end of the estimates, we're looking at around 5% of global GDP is processed as criminal assets each year. So that's around 2 trillion euros or $2 trillion, if you like. That's more than the GDP of most countries around the world, right? But if we look behind the numbers, then you're looking at, well, what actually does this really mean for society? Terrorism ruins lives, destroys families. Around nearly 2.5 million people are sold as commodities through human trafficking each year. Sold into slavery or into sexual exploitation, pretty nasty things. Huge amounts of drugs, again, ruin lives, big problem for society. And then we can even look at the impact on our planet, right? The species being pushed to the brink of extinction, deforestation and what have you. That is often linked to financial crime. So we can see here that it's a pretty significant problem. It's not victimless at all, and that we really should all be working together to make an impact to prevent this financial crime. So let's now look a little bit about what types of data are used within financial crime risk management. And it's really split into two key areas: internal data and external data. Now, internal data, we're really talking about customer data. So that's the information that an organization will have on you, which they use for profiling. So everyone's profiled. They need to sort of understand our behavior, the devices that we're using, the products that we're using, basically to understand, to give us a profile that they can then use for things like customer risk scoring, which we'll come on to later. Then you have all the transactional throughput within the organization, which obviously can be huge. If we're talking about banks, often have millions of customers, and many of those customers might be doing hundreds of transactions a day. So vast amounts of transactional data, and that's used for transaction monitoring, amongst other things. And transaction monitoring is where you look for suspicious behavior in your transactional base. Then you have the information that you bring into the organization. Sometimes it can be bought from vendors, but it can also be some public open source information that you can get for free. There we'd be talking about things like screening data, where everyone's onboarded. If you open a bank account or some other sort of account with a financial services firm, and as part of that process, they'll do background checks on you, right? So they'll do things like check that you're not on a sanctions list, because if you are, they can't deal with you; it's illegal. PEP lists, politically exposed persons. Are you a PEP? Or are you a family member of a PEP or an associate of a PEP? They need to know that. Doesn't mean they can't do business with you, but they need to know that, because it presents a higher risk of bribery and corruption, amongst other things. There might be certain groups or people that the institution might not want to work with. for reputational reasons, might not be on lists, but there's reasons they might not want to deal with you, in which case they might use adverse media. Then increasing regulations around understanding the ownership, the company structure and ownership of businesses means from a corporate perspective, as part of the screening process of companies, we now need to do beneficial ownership checks as well as other company data checks. Then we have ID data, so all your KYC documents. If you've ever opened a bank account, you know you need to show things like your passport, some sort of utility bill or something. And then you have like threat and risk intelligence. What we're talking about there is understanding of how your organization could be misused by criminals. We'll talk about how that links to the risk assessment later on. The last piece of the puzzle is a SAR, which is a suspicious activity report. And what banks and other regulated entities need to do is to send these reports to the Financial Investigations Unit, or FIU, with suspicious activity so that they can then investigate that potential crime within the organization. So that's the basically type of data that we will see used within financial crime risk management. A little bit about the evolution. So starting obviously from left to right, as is normal. Back in the early 1990s, mostly a paper-based economy, paper-based transactions. So mostly cash, paper, checks, if you remember those things, paper, bankers' drafts, paper, travelers' checks. So there was very little data relative to now. And then as we go through this with the emergence of e-commerce, with different ways of paying, different payment methods, things have slowly become more and more moved away from paper-based transactions to digital transactions. More people have become banked and other things. So the volume of the volume of customer data has grown exponentially. And we're now at a point whereby people talk about Bitcoin or other virtual currencies, crypto, and very, very little cash. Here in Sweden, very few people use cash nowadays at all. In fact, if you go to downtown Stockholm, there's a good chance that if you go into a shop or a cafe or a bar with cash, they'll say, we don't take cash. You need to either use Swish, which is a mobile payment method, or your card, or your phone, or your watch, or whatever it might be. Not this sort of watch. Anyway, so that's increased the transactional and customer data volumes. In line with that, the next line down, we've obviously had all these new rules and regulations coming in. I'm not going to go through all of them. You can see them for yourself there. But in terms of a timeline, there's been more and more complexity added in terms of what is demanded and what financial crime data is needed in order to meet the needs of good compliance. So everything's getting more complicated. Actually, one thing I just wanted to point out on this slide is in the middle here we have something called what's called a move towards an RBA. RBA is risk-based approach, and what that means is before sort of the mid 2000s, compliance was much more of a prescriptive checkbox exercise. And in the mid 2000s, we moved towards more of a risk-based approach. Now, the risk-based approach really means that firms, financial services firms, need to do their own risk assessment. They need to basically go through a process that highlights what their highest risks are. And they do that by doing a risk assessment. And the risk assessment is very important because the risk assessment will drive good intelligence and good data, things we can call like threat intelligence is one, key risk indicators, into a number of different processes within the organization. So this wheel here, which we've taken from the Swedish FSA, sort of for anti-money laundering framework, looks at the different areas where data might be used within the financial crime framework. Of course, it's used everywhere. But when we start with a risk assessment and we do a good risk assessment, that's going to give us information that we can use to de-risk our products. So if we know, having done a risk assessment that highlights what our greatest risks are, so we know that based on where we are, the sort of customers that we have, the products that we have, we understand that these are the criminal threats that we face, we can sort of understand where we might not want to give a particular product to a particular group, for example, because we know that by doing that, we're going to reduce our risk of financial crime. The risk assessment will also feed into the policies, feed data into the policies that we have. So we can, for example, make sure that the policies and procedures that we have as an organization reflect the risk assessment that we've done. Likewise with training. If you've worked at a bank, you'll understand that every year you need to do some compulsory training, like AML training. But actually, what the business-wide risk assessment or financial crime risk assessment, that's another way of describing it, can provide to you, is much more detailed information on where there might be very specific risks that you want to mitigate, that you can mitigate through training. And again, what are we trying to do here? We're trying to prevent financial crime. Then we have the systems, and in the systems, we're likely to incorporate some of that other external data that we talked about. So within KYC, we're going to be doing sort of screening, capturing ID documents, so on and so forth. Obviously, at that point, we're going to be collecting and doing screening, PEPs, UBOs, sanctions, and what have you. We also have to do modeling. Modeling is basically the way that we're set up to find the risks within our customer base through customer profiling, or our transactional base through transactional monitoring. And again, we need to ensure that the key risk indicators, those being customer risks, so customer red flags, where our product risks are, where our transactional risks are, or transactional typologies are, channel risks or onboarding risks and geographical risks, we need to make sure that those key risk indicators that come from those are fed into our systems, so that when we are doing our customer risk scoring modeling, when we're doing our transaction monitoring modeling, we know that we are going to we're going to optimize those to make sure that we've got the best chance of finding criminality within our organization. So the risk assessment feeds all of that information into these other, what we call mitigating actions, basically the control framework within our institution. So this slide kind of summarizes that a little bit. So the value of good threat intelligence, it's knowledge of how you can be misused by criminals and where the highest risks are. And that's essential to creating the effective mitigating actions. So again, you know where your highest risks are. You then understand that they're your vulnerabilities. That's where you should be spending your time, your resource, your money. And that in turn will then reduce the chance that you have of being misused by criminals, because you understand their methods and their modus operandi, right? Then we have the different things. Again, just repeating these from the previous slide. Business-wide risk assessment, also product risk assessments, and then your AML and other policies and the AML models. And just one other thing to point out there is that the reason you want to get this right when we're talking about transaction monitoring and screening is you're dealing with lots and lots of data. If you think about, you're monitoring all those transactions, you're monitoring your entire customer base, for example. If you're doing it badly, you're going to have a lot of what we call false positives, like bad alerts. If the output from that is that it's a really significant number, as high as 90%, the impact on that is high cost. We've seen organizations having to literally throw people at the problem, trying to close down all these bad alerts that's basically caused by bad intelligence or bad information going into the systems that are then doing the processing and then providing the output. You've also got the danger of missing false negatives, or the danger of missing the actual alerts themselves as you're sort of working through this huge body of work. So it's absolutely critical that you feed in good financial crime intelligence, and that data will then in turn provide your good outcomes in the processes that you have. So yeah, I think timing's good to sort of finish on this slide. So this is the last slide that I'm going to focus on today. So now I'm going to look at what does the future look like? What are the emerging technologies and data within financial crime? So I guess the first thing to point out is, I'm sure we've all heard of artificial intelligence, which also includes machine learning and natural language processing. That's now joining the fight against financial crime. So one of the challenges, or one of the problem areas within transaction monitoring and customer screening, for example, but particularly transaction monitoring, is that the old legacy ways of monitoring was very much done on a kind of linear or a very rules-based approach. So that's to say, if something breaks a certain threshold, like a certain value or volume, to raise an alert, and that can produce a lot of that in isolation can produce a lot of bad alerts, because just because someone's transacted with a certain country or made a big purchase or whatever it might be, it might not actually be an indication of financial crime. However, what AI and machine learning can help with you, and the fact that there's a lot of data that we have now actually helps with this, is it can start to look at doing much more predictive or statistical modeling, where rather than just looking at breaking a single threshold, you can actually look at those rules in conjunction with other things like, has this person changed their account details? Have they changed their device? Have they done a number of different behavioral things, as well as the rules that are going to give a much clearer picture of, this pattern, if you like, of activity suggests that gives a much higher probability that there is financial crime than just a single isolated incident that's broken a threshold or a parameter or something. So that's important. It's going to reduce the number of false or bad alerts. The next thing is fixing data. Artificial intelligence is excellent at finding errors or gaps in data and enriching data. So in processes like KYC, where there's still a lot of manual processes, where there's a lot of possibility of failure in the data, AI can really help to fix and enhance the underlying data to produce, again, better outcomes. You might have heard of robotic process automation. That's really helpful too. Really where this helps is with very laborious or tedious tasks that humans do. Often people have to do tasks that take a lot of time or of relatively little value, but they need to be done. Robots can often do those tasks better. They can do them for 24 hours a day, not like people that need to work 9 to 5 and then go home. A couple of examples of that. One would be SARS. So these are the template suspicious activity reports. These are those templates that are filled in and sent to the FIU. There's a use case for robotic process automation for that. I've got my own example of this when I worked for Acuity with Bankers Almanac. We worked with one of the biggest banks in the Nordics, and they had a number of different people that were having to go into the Bankers Almanac tool and find documents within that. So it does correspondent banking, KYC, but within that there are a lot of different KYC documents that you can find. And what people were having to do is go and find those documents manually, download them, and then put them in a folder. It meant people on good salaries basically were doing all this very tedious manual work. And we worked with this particular bank to assign one of those licenses to a robot who could actually do that work 24 hours a day. And the value of that as well being that the analyst could then actually go on and do the actual analyst work, do the KYC work, which was much, much higher value. And the last thing to point out is structured data. So just to go back to the idea of this threat intelligence I was talking about earlier as an example. So when we talk about threat intelligence, again, we're talking about sort of finding reports from FATF, from Europol, Interpol, police forces that help us understand the methods and the modus operandi that criminals use. Now, that's unstructured data. So you need to go to PDFs, you need to go to this website, that website, to find all this information, to gather it, to collect it, and then you have to make sense of it and what's the impact on our business. Using natural language processing and machine learning, you can use tools to go and actually find that information, collect it, and structure it. That saves a lot of time. And you can then turn it into usable data points that feed into the anti-financial crime processes for much better effect, as I said here, such as threat intelligence. And that's actually something that Keynote does, just to get that in at the end. So with that, I have reached my time, so I have to stop there. Hopefully that's been a useful 25 minutes just to get a bit of an understanding of financial crime data and how we use that in daily operations to help prevent financial crime. So with that, I'd like to thank you for joining and wish you a continued good day. Thank you very much.